Good afternoon, class. Today we're going to discuss the equity method of accounting for investments. I'm going to briefly describe 4 methods accepted by GAAP to report equity investments. I'm also going to describe the equity method in detail with an example. So learning objective 1-1, describe in general the various methods of accounting for an investment in equity shares of another company. The reporting of investments in corporate equity securities. So GAAP recognizes 4 methods to report investments in other companies. You have the fair value method, cost method for equity securities without readily determinable fair values, consolidation of financial statements, and the equity method. The method selected depends upon the degree of influence the investor, the stockholder, has over the investee. So the fair value method. You use it when an investor holds a small percentage of equity securities of an investee. Investors cannot significantly affect the investee's operations, and investments is made in anticipation of dividends or market appreciation. Recording the fair value method. Initial investments in equity securities, when significant influence and control are not present, are recorded at cost. Adjusted to fair value if fair value is determinable. If fair value is not determinable, remains at cost. Changes in fair values are recognized as income. Dividends declared on the securities are recognized as income as well. The fair value method and impairment assessment. GAAP allows for 2 fair value assessments that may affect cost method amounts reported on the financial statements. Periodic assessment for impairment to determine if the fair value of the investment is less than its carrying amount, and recognition of the observable price changes in orderly transactions for the identical or similar investment of the same issuer as unrealized holding gains or losses. Consolidation of financial statements. It's required when investors' ownership exceeds 50% of an organization's outstanding voting stock. When a majority of a voting stock is held, investors-investee relationship is so closely connected that the 2 corporations are viewed as a single entity. One set of financial statements prepared to consolidate all accounts of the parent company and all of its controlled subsidiaries as a single entity. Also, for the consolidation of financial statements, FASB ASC Section 81010-05, variable interest entities includes entities controlled through special contractual arrangements, not through voting stock interest. It's intended to combat misuse of special purpose entities to keep large amounts of assets and liabilities off the balance sheet, known as off-balance sheet financing. So the equity method. You use it when the investor has an ability to exercise significant influence on the investee's operations. Ownership is between 20 and 50%. Significant influence might be present with much lower ownership percentages, as a note. Under the equity method, investors' shares of investee dividends declared are recorded as decreases in the investment account, not income. So here we have a summary of accounting methods. It's a chart here describing the different criterion, the normal ownership level, and the applicable accounting method. And so here, inability to significantly influence is less than 20%. You'll use the fair value or cost method. Ability to significantly influence 20 to 50%. You choose between the equity method or the fair value method. Control through voting interest more than 50%. Consolidated financial statements. Control through variable interest, governance documents, and contracts. Primary beneficiary status, no ownership required. And again, consolidated financial statements. So this is a good roadmap to use. So learning objective 1-2, identify the sole criteria for applying the equity method of accounting and know the guidelines to assess whether the criteria is met. Criteria for utilizing the equity method: significant influence, ASC topic 323, representation of the investee's board of directors, participation in investee's policymaking process, material intra-entity transactions, interchange of managerial personnel, technology dependency, and other investee ownership percentages. So these are items that signify significant influence. Limitations of the equity method: applicability. So regardless of the investor's degree of ownership, the equity method is not appropriate if investments demonstrate the following: an agreement exists between the investor and investee by which the investor surrenders significant rights as a shareholder. A concentration of ownership operates the investee without regard for the views of the investor. The investor attempts but fails to obtain representation on the investee's board of directors. If an entity can exercise control over an investee, regardless of ownership level, consolidation is required. So extensions of the equity method applicability. So also for some investments that fall short of or exceed the 20 to 50% ownership, the equity method is appropriately used for financial reporting. Conditions can exist where the equity method is appropriate despite a majority of ownership interests. If the non-controlling rights are so restrictive as to call into question whether control rests with the majority owner, the equity method is employed for financial reporting rather than consolidation. So accounting for increases in the investment in the equity method, the investor increases the investment account as the investee earns and reports income. The investor uses the accrual method to record investment income, recognizing it in the same time period as the investee earns it. And upward adjustments in the asset balance are recorded as soon as the investee makes a profit. The investor reduces the investee account if the investee reports a loss. Accounting for a decrease in investment, the equity method. The investor decreases its investment account's carrying value for its share of investee cash dividends. When the investee declares a cash dividend, its owner's equity decreases. The investor shall recognize its share of the earnings and losses of an investee in the periods for which they are reported by the investee in its financial statements. So here we have an equity method example. So big company owns 20% interest in little company, purchased on January 1st, 2017 for $200,000. Little reports net income of $250,000, $300,000, and $400,000 respectively in the next 3 years, while declaring dividends of $500,000, $100,000, and $200,000. The fair value of Big's investment in Little, as determined by market prices, were $245,000, $282,000, and $325,000 at the end of 2017, 2018, and 2019, respectively. So here, they've given us an illustration comparing the fair value method and the equity method. And that's because when the ownership is between 20 and 50%, it really depends on the influence, whether influence is not significant or influence is significant, whether you choose between the fair value method or the equity method. Creating a table like this will help you when you're the next step when you need to create the journal entries to recognize the activity. And so the first part of this table here, this is the information that was given to us about little company. This information here is the fair value method applied for big company. And this is the equity method for big company. So I'm going to make some notes here for this schedule. So again, this is because ownership was 20%. So it falls between the 20% and the 50%. So this information was given to us on the previous slide. And we'll call this column A and this column B. So in recording the flow of this column, the flow of this worksheet, the dividend income, so accounting for big company when influence is not significant, the fair value method, the dividend income is 20% of column B. So that's 50,000, 20% of the 50,000, which is 10,000, 20% of 100,000, and 20% of 200,000. The carrying amount here was given to us on the previous slide. It was the market balance for the years. Give me 1 second. Okay. It was the market. And the fair value change to income is computed by the change of the carrying amount throughout the years. So here it was increased by 37,000. It increased by 43,000. Originally, it was 200,000, and it increased by the 45 to start off. So this column is computed by the change in the carrying amount of investments. So when we move over to accounting by big company when influence is significant, which is the equity method. And so under the equity method, equity investee income, the first column, is 20% of column A. So here it states equity and investee income is 20% of the current year income reported by little company. And so I'm computing that little company income for little company was recognized at 250,000 for 2017 times 20% gives you the 50,000. That's noted here. The next year, 2018, was 300,000 times 20% give you 60,000 here. And the same with the next year, 400,000 times 20% would be the 80,000. That's how you compute this column. Now the carrying amount of investment is a little more complex. And so down here, they explain it, telling you the carrying amount of the investment under the equity method is the original cost plus income recognized less the dividend. And so for 2017, they recorded 240,000. That 240,000 came from the 200,000 original cost plus the $50,000 dividend they declared over here, less $10,000. And the $10,000 came from the $50,000 dividend times 20%. And that's how they computed the 240,000. So the next year, the 280,000 will be computed by the 200,000 original cost plus $100,000 dividend for 2018 less $100,000 times 20%, which will be subtracting 20,000, and that'll give you 280,000. So again, this schedule helps you a lot when you're trying to compute the journal entries. And to note that what they didn't include here, just to break out under the equity method, the dividend would be very similar to the dividends declared by little company. It'll be 50,000, 100, and 200,000. So moving on. So learning objective 1-3, prepare basic equity method journal entries for an investor and describe the financial reporting for the equity method. And so here, big company records the following journal entries to apply the equity method for its investment in little company for 2017. So investment in little company. So here you have the recognizing the first entry is Big's accrues income based on the investee's reported earnings. And so here, investment in little company is debited, and you credit equity and investee income. So to accrue the earnings of the 20% owned investee, 250,000 times 20%. And so if we go back to our schedule, that's this amount here. you're recognizing in 2017 your equity in investee company. That's 250,000 times 20%. The calculation here. So that's the first entry. The second entry, Big records dividend declaration and reduction in Little's net assets. And so here you're recognizing the $10,000 that was declared in the dividend. And so again, I noted it here, the $50,000 for the dividend that's declared, and they received 20%, which is $10,000. And so when they declared it, it's a debit to dividend receivable and a credit to investment in Little Company to record a dividend declaration by Little Company of $50,000 times 20%. When the actual dividend is issued, which is third entry, Big reports the collection of cash dividends. You're going to debit cash and you're going to credit the dividend receivable to record collection of the cash dividends. So these are the journal entries you'll do, and the similar entries will be done for 18 and 19. On objective 1-4, allocate the cost of an equity method investment and compute amortization expense to match revenues recognized from the investment to the excess of the investor's cost over the investee's book value. So excess of investment cost over the book value acquired. So differences may exist between the company's book value and the fair value because of the following. The fair value is based on multiple factors, including but not limited to profitability, new products, expected dividend payments, projected operating results, general economic conditions. And the stock prices are based partially on the perceived worth of the company's net assets, amounts that often vary from underlying book values. So assets and liability accounts on the balance sheet tend to measure historic costs rather than current value. So reported figures are affected by the accounting methods selected and lead to different book values. For example, if a company uses LIFO or FIFO for inventory methods or the straight line for depreciation. When purchase price exceeds book value of an investment acquired, the difference must be identified. The asset may be undervalued on the investee's books because the fair value of some assets and liabilities are different from their book values. The investee may be willing to pay extra because future benefits are expected to accrue from the investment, or extra payment that cannot be attributed to a specific asset or liability is assigned to the intangible goodwill. So excess of investment cost over book value acquired. So this is an example of what we're discussing now. Grande Company is negotiating the acquisition of 30% of the outstanding shares of Chico Company. Chico's balance sheet reports assets of $500,000 and liabilities of $300,000 for a net book value of $200,000. Grande determines that Chico's equipment is undervalued in the company financials records by $60,000. One of its patents is also undervalued, but only by $40,000. Adding these valuation adjustments to Chico's book value indicates that the company's net assets are estimated to be valued at $300,000. Therefore, Grande offers $90,000 for a 30% share of the investee's outstanding stock. So, what they're discussing about the book value being different than the fair value here, they identified some items when they did their research that were valued differently than how the company is valuing them. And when they made their offer based on that. So Grande's purchase price is in excess of the proportionate share of Chico's book value, which can be attributed to two specific accounts, the equipment and the patents. So no part of the extra payment is traceable to any other projected future benefit. The cost of Grande's investment is allocated as follows. So this little schedule shows how they compute the payment by the investor was $90,000. The percentage of the book value acquired, the original cost was $200,000. They purchased 30%. So that's $60,000 is the value, that's $60,000. So the payment in excess of the book value was $30,000. So the excess payment identified with specific assets. So here you have the equipment, $60,000 undervaluation, and the patent for $40,000 with an undervaluation. So 30% of both of those items equals the $30,000. And here you have excess payment not identified with specific assets such as goodwill, which was 0. So this little schedule here helps you compute the excess. So the amortization process. So once you've computed this, the payment relating to cash assets, except for land and goodwill and other indefinite life intangibles, should be amortized over an appropriate time period. So here you have the equipment. The cost assigned was $18,000, and the patent, the cost assigned was $12,000. Useful life 10 years. Patent's useful life 5 years. Goodwill, there was no goodwill here to calculate. And so here, the $1,800 and $2,400 is the annual amortization amount, which equals to $4,200. The annual expense for 5 years until the patent cost is completely amortized. So goodwill associated with the equity method investments, for the most part, is measured in the same manner as goodwill arising from a business combination. Tested for declines in value and impairment, equity method investments are tested in their entirety for permanent declines in value. So the amortization process, the journal entries. So here, to record the annual expense for the difference in the business excess, Grande reduces the investment balance in the same way it would amortize the cost of any other asset that had a limited life. At the end of the first year of holdings, the investors records the following journal entry under the equity method. So here you debit equity and investee income and credit investment in Chico Company for the $4,200. To record the amortization of excess payment allocated to equipment and patent. So this is to recognize the difference that they paid in excess of the book value when they acquired the 30%. That's the end of the key points.